2014 was a solid year in the equity markets, and that helped to improve the performance of Insurers' variable annuity blocks. But since many VA products were sold in times when interest rate guarantees reflected the current and better interest rate environment, reinvestment rates, along with policyholder behavior in the tail, are just two of the challenges emanating from companies' legacy VA blocks of business. That's the focus of a recent AM Best special report, and we spoke to Assistant Vice President Rosemarie Mirabella about how deep the worries over these blocks run.
Our concern is primarily centered around the tail risk. It relates to the embedded richness of the guarantees, the equity market risk, the interest rate risk, and additionally we have some concerns regarding policyholder utilization. Many of these products are just starting to get to the point where we'll get good historical experience to see the level of utilization and to see whether or not the pricing assumptions made in lapses are realistic or not. And they've taken action in a number of areas over the last several years. Changes have included increasing the rider fees, product redesigns, reducing the level of guarantees, repricing to reflect lower interest rate and lapse assumptions, and changing the asset allocation strategy. In addition, companies have managed their overall sales profile fairly tightly to make sure that they're not taking on too much balance sheet risk. And finally, they have offered some specialized programs to reduce some of these legacy blocks to incent policyholders to surrender the policies. We see companies returning to the traditional sales model, specifically what's called investment-only variable annuities, which are products which have no guarantees. And we see very significant carriers increasing their sales allocation, which can be as much as 30 to 50% of current year sales. And these products have no risk, essentially, to the insurance industry. The other thing that's new is we're starting to see the emergence of what I'm calling hybrid products, which is sort of blurring the lines between indexed annuities and variable annuities. So there's something called an index variable annuity product, which is tied to an index, say the S&P 500. This product offers upside protection, just like any variable annuity or indexed annuity would. But it has a somewhat unique feature in that policyholders will absorb losses below a specified buffer level, say 10%, for example. The other thing that we see is that reinsurance capacity is returning to the space on a highly selective basis, but overall that's a positive for the industry. And then finally, I would say that the industry continues to remain very proactive in adapting its enterprise risk management practices and monitoring the overall risk profile of its exposure.